speaker for today's session, Bhadresh Doshi, Vice President Suhas, Honorary Secretary Meherbhai, Past President Pranay my friends present here and online viewers. Good evening and a very warm welcome to all of you to this lecture meeting on the Taxation Law Amendment Ordinance 2019. Usually, such lecture meetings are open for non-members also. So, for the benefit of non-members, I would just like to spend 2 minutes and introduce the Bombay Chartered Accountants Society for you. The Bombay Chartered Accountants Society is a not-for-profit organization. It's a public charitable trust which engages in the spreading of knowledge and education to chartered accountants. And it was formed in 1949. It is 70 years old young, and it is perhaps the country's largest and the oldest voluntary organization of chartered accountants. Unlike the institute, which is the statutory body, we are just 6 days younger than the Institute of Chartered Accountants of India, and over the past 70 years, BCA has made a niche for itself, and it is known for the quality of its programs. It's known for its ethical practices, and it's also known for the quality of its educational programs and publications. We are into the 52nd year of non-stop publication of our BCA journal, which is a prized publication. It comes out monthly. And currently we are about 9,000 members. But more heartening to know is that currently we have about more than 31,000 social media followers. And we clock about 2.5 lakh of educational, 2.5 lakh hours, man hours of educational programs every year. Friends, our constitution doesn't allow non-chartered accountants to be members, but for non-chartered accountants who are listening to this, I would just urge to follow us on all the four, social media platforms that we are present on. On BCAS Global, that's our handle on the social media platform. For example, this particular lecture is relayed live on our YouTube channel, and all our past lecture meetings are available on the YouTube channel free of cost to be viewed. Friends, coming to today's topic. Since the past few months, a lot has been said about the sluggish growth in the Indian economy, and the government was under constant attack for its inactiveness. It faced a lot of criticism from certain sections of the press, opposition parties, and certain industrialists. The Indian economy is passing through a delicate phase, with the GDP growth rate falling to about 5% for the quarter ended June 2019. With this background, earlier, towards the end of September, the Finance Minister introduced the Taxation Law Amendment Ordinance 2019, or the Ordinance as it is called, to stimulate growth, enhance investment in the country. This ordinance is a bold and right step towards reviving the industrial cycle and improving the sentiments of the industry. The government has reduced tax rates and the incentives that were currently available under the Act. These changes have actually been done to lure foreign investments, provide boost to manufacturing sector, and improve the business sentiments, and to push consumer demand. These amendments include reduction in corporate tax rate for domestic companies to 22%, subject to fulfillment of conditions that they will not avail certain deduction or exemptions which are available currently under the Income Tax Act. This will be an option available to domestic companies by way of an one-time irrevocable option, just like in our accounting or auditing parlance, how we have, if you are shifting to Ind AS, there is no way going back. So similar to that, if you are shifting to the new tax regime, it will be a one-way traffic. The base rate of MAT has been reduced from 18.5 to 15%. A further reduction in corporate tax for 15% for certain new domestic companies subject to fulfillment of certain conditions. Relief on tax in income distribution by way of buyback in respect of listed companies announced before 5th of July. All these changes will be applicable from the current financial year, that is from 2019-20 onwards. These amendments bring India very close in the competitive map, if not equal to the economies of Southeast Asia like China, Thailand, Indonesia, Vietnam, Hong Kong, and so on. The capital markets were quick in responding to this ordinance and gave a big thumbs up when the Sensex moved 2,000 points on the day on which or 5.3% in a single day when this ordinance was announced. Since these amendments are made applicable with immediate effect, a lot of companies will go back to the drawing boards and work out cost benefit analysis and decide whether to exercise the option or no. Many large corporates have disclosed their quarterly results and they are evaluating the impact of whether to opting for the reduced rate regime, and that call will be taken at the end, and many of them have disclosed that in their results also. A few companies like Asian Paints have already opted for this lower tax rate as introduced by the ordinance, resulting in certain reversals of tax expenses. What are the deductions and exemptions that will not be available if you are opting for the new regime? What are the conditions to be fulfilled by new companies to have a 15% tax rate? What will happen to the carried forward unabsorbed business losses and unabsorbed depreciation and MAT credit for companies opting for the new tax regime? Whether the tax rate will genuinely benefit companies or it just means a way to remove certain tax exemptions or deductions which are available. What impact will this have on companies' tax expenses, including deferred tax? For all this discussion and much more, today we have Bhadresh Doshi with us. Thank you, Bhadresh, for sparing time and agreeing to address our members for the benefit. It's always a pleasure to introduce the speaker to you. As I introduced him by saying that he's no stranger to the Bombay Chartered Accountants Society. Definitely he's not a stranger to the Bombay Chartered Accountants Society. He's a commerce graduate and a chartered accountant and of the 2001 batch. And according to his CV, he has stood rank holder in all the three examinations of his chartered accountancy. The best being the 11th rank in the exam that matters the most, the CA final. After his CA, he's also done an advanced diploma in international tax, where he cleared the paper on principles of international tax, and as per the course conducted by the Chartered Institute of Taxation in UK. He is in practice in his own name since the past 17 years, and he's also a partner with a very well-known firm called CVK and Associates. His core areas of practice are litigation matters up to the tribunal level, and his advisory practice includes taxation matters, both international as well as domestic tax. His association with BCA really goes a long way. Currently he's a member of the Taxation Committee. He has he co-authors a controversy article which is published every month in the journal. He is also an author of the book on income declaration scheme in 2016, which he has got an occasion to hand over to the then late finance minister Arun Jaitley. He has been a co-author of the tax paper in RRC, and also he is a co-author of the budget publication that comes out. Currently, with other associations, he is the chairman of the Journal Committee and a member of the Managing Council of the Chamber of Tax Consultants. He has taught direct tax to CA final students for 7 years, and that is where I think so his academic intellectual comes there. He's co-author of the WIRC Referencer Manual. He has written several articles on income tax which were published by the CA Journal, Taxman Journal, etc. He has presented papers on taxation at various forums, at various study circles and institute platforms. And as I told you, he's a besides all this, he's a very close friend and an ardent supporter of the society and its activities. Friends, with these words, I introduce Bhadresh to you. Before I hand over the proceedings to him, I will just request our Vice President Suhas to hand over a token of our remembrance of the evening spent with us to Bhadresh. Thank you. The floor is all yours. Thank you.
the President of the Society, Manish ji, the Vice President, Suhas ji, other office bearers of the Society, and my BCA's family and online viewers. Good evening to all of you. The President has already set the context of the topic of the day, that is Taxation Laws Amendment Ordinance 2019. I would just like to add one thing which President has already mentioned about the important features of this particular ordinance. This ordinance was notified on 20th of September 2019, exactly 2 months before today as we stand. And in the press release, it was being announced that the benefits, or rather the revenue foregone by the income tax department on account of the several announcements in this particular ordinance, is about 1,45,000 crores. I don't want to comment on that figure, and perhaps I am not the right person who can make any comments on this particular figure, whether it is right or wrong. There was a lot of debate which was going on in the news media as to whether this figure is pertaining to only 1 year or they are talking about, more than 1 year. But certainly assuming that if this is the correct facts and figures, 1,45,000 crore is something, very big amount, more than 10% of the collection target which is being set for this financial year. And more particularly in those days when the collection is going down because of several reasons. And therefore it is very important for us to make a study of this particular ordinance, and whatever and wherever the benefits which can be availed through this particular ordinance, one need to explore the possibilities. In this ordinance, friends, there are 5 important major announcements which have been made. The first one is reduction in the rates of surcharge as far as those individuals, and more particularly for FPIs, which was much debated. That is the first one. The second one is for the corporates, domestic company, as President has mentioned. There are 2 sections which have been incorporated under the Income Tax Act, that is 115 BA, BAA and BAB, giving a special scheme of taxation for the domestic companies as an option. And the fourth announcement is with respect to the MAT liability, the base rate of MAT has been reduced from 18.5% to 15% to all domestic companies in general, not necessarily only to those companies who exercise this new option of paying tax under 115 BAA or BAB. And the last one, a slight relaxation as far as the buyback tax is concerned. The buyback tax which was announced on 5th of July, announced in the sense that it was made applicable even to listed shares. A relaxation has been given to those companies which are already announced their buyback prior to 5th of July, that they need not pay the buyback tax. So there will be no taxation at the company's level. The taxation will be shifted to the shareholder level only to those class of companies which have already announced their buyback prior to that date, that is 5th of July 2019. So friends, these are the only 5 announcements which have been made through this particular ordinance. This ordinance is running about 9 pages, and with this background, let us try to decode this ordinance in more detail. So the first one, I'll begin with the rollback of surcharge. So the super rich tax, as we call it, was being announced by this finance minister on 5th of July 2019 when she presented the finance bill number 2 of 2019. The higher rate of surcharge, the existing rate of surcharge were only 10 and 15%. New 2 categories of the surcharge were introduced in that particular budget proposal, that is 25% and 37%. So we had in all 5 categories of the surcharge. That is up to 50 lakhs of income, there is no surcharge. It continues as it is. The income level from 50 lakhs to 1 crore, the surcharge rate is only 10%. If the income is more than 1 crore, then the rate of surcharge was 15%. Then new categories were introduced. 2 new categories, that is 25% surcharge and 37% surcharge, if your income level exceeds 2 crore and 5 crore respectively. These were applicable to individual HUF, AOP, BOI, and artificial juridical person. And then immediately after the announcement of this increase in surcharge, mainly this 25% and 37%, a lot of hue and cry in the market. More particularly, the FPIs were hit on account of the super reach tax, because they were being incorporated as association of persons and not companies, and therefore this higher rate of surcharge were also applicable to these categories of investors. The announcement with respect to increase in surcharge was made on 5th of July 2019 when the finance bill was presented. We took 1.5 months because this announcement of reduction in the rate of surcharge for this categories of investor was first made on 23rd of August 2019, and then it was followed by a formal announcement through this particular ordinance on 20th of September 2019. So we took about 1.5 months to realize the impact of this increase in surcharge, which was already made effective from this assessment year. And fortunately, realizing the impact of this increase in surcharge, now there is a rationalization in the peak rate, that is 25% and 37%. It has not been removed totally. The ordinance says that this increased rate of surcharge, the last two categories, the top two categories rates of surcharge, that is 25% and 37%, will not apply in certain limited cases. And what are those limited cases? Two cases. Number one, with respect to any SSE to which this increased rate of surcharge were applicable, if they are earning income in the nature of short-term capital gain or long-term capital gain from the transactions which are charged with STT, and therefore they are taxable under section 111A or 112A. While calculating the tax liability on this particular short-term capital gain or long-term capital gain, this increased rate of surcharge, that is 25% and 37%, will not apply, irrespective of the fact that whether these SSEs are resident or non-resident. If these SSEs were liable to these increased rates of surcharge, in that case, for these transactions, the tax computed out of these transactions will not be subject to these higher rates of surcharge. That is number one. And the second, as we all know, that FPIs were also hit because of this increase in surcharge. So FPIs also have been excluded from the applicability of these two peak rate of surcharge. So the capital gain income of FPI, which is required to be taxed in accordance with the provision of section 115 AD, even on this tax on this capital gain, which is computed in accordance with section 115 AD, this higher rate of surcharge, 25% and 37%, will not apply. However, the lower rate of surcharge, that is 10% and 15%, will continue to apply depending upon the amount of the income which they earn in a particular year. And when I talk about FPI, I need to mention that this relaxation in the rate of surcharge will also apply not only to their transactions in the cash market, but it will also apply to the income which is computed in the transactions in derivative market. It's because the definition of capital asset specifically provides that for FPI, the securities which they have purchased will be considered as capital assets always, and therefore the definition of security includes the derivatives, and therefore even the income arising out of derivative transactions of FPI will also not be subject to the higher rate of surcharge of 25% and 37%, and this has been expressly clarified in the press release which was issued by CBDT in this respect. And therefore, let's try to understand as to what is the impact of this particular change in the rate of surcharge. And in order to understand this, friends, we need to divide all the transactions on which we need to compute the tax and surcharge into 6 different categories for this purpose. So the first category is a case where the total income of the SSE does not exceed 50 lakhs. I'm on the left side of my slide. So the first category is a case where the total income of the SSE does not exceed 50 lakhs. Well, there is no surcharge as far as this category of the SSE is concerned. There is no change. There is no change, in fact, in the first 3 categories at all. The change is with respect to only the last 3 categories, which is there in my slide. So the second category is a case where the income is more than 50 lakhs, but it is not more than 1 crore. The surcharge rate is 10% and it will continue as it is, irrespective of the composition of the income. The third category is a case where my income is more than 1 crore but not more than 2 crore. There also the existing surcharge at 15%, it will continue irrespective of the component of the income. Coming to the last three categories, so here we need to be very careful. So moment you go on to the third category, we need to understand the breakup of the income. And here we need to see that first my other income, whether it is exceeding 2 crore or not. And when I say other income, I mean my other income means other than those capital gains which are subject to tax under 111A, 112A or 115 AD in respect of FPIs. So exclude those capital gains for a moment, and excluding all those three capital gains, if my income other than these capital gains, the specific capital gains, if my other income is more than 2 crore but not more than 5 crore, then the higher rate of surcharge of 25% will apply, but it will apply only with respect to my tax liability which I am computing on my other income. As far as the tax liability which I compute on my this capital gain 111A, 112A or 115 AD, the higher rate of surcharge of 25% will not apply. The surcharge of 15% will continue, is because my total income is otherwise is exceeding 2 crore, and therefore surcharge at the rate of 15% is at least required to be paid on the tax liability which I am computing on my capital gain, but not at the higher rate of 25%. Then if we move on further, once again, if my other income other than this capital gain is more than 5 crores, excluding this capital gain, in that case, the peak rate of surcharge of 37% will apply. Once again, only with respect to the tax liability which we compute only on this other income and not with respect to the tax liability computed on the capital gain. So the tax liability computed on capital gain falling under 111A, 112A or 115 AD will continue to be subject to the surcharge only at the rate of 15% and never at 25% or 37%. And the last category is where my total income, including all this capital gains, 111A, 112A and 115 AD, is more than 2 crores, but the other income is less than 2 crores. Even in that case, the surcharge will continue at 15% on the total tax liability, because here we are talking about surcharge, applicability of surcharge only at 15% and not at 25% and 37%. And therefore, if I just tell you simply, I have given the case studies in my slides, 2 case studies. So just to mention here is that in this particular case study, my total income, including all different types of capital gain, is 4.5 crores. But since my other income, other than capital gain, the second column, is only 1.5 crore, I need to apply surcharge only 15% on the tax liability which I compute on this 1.5 crores at slab rates. I need not look at my total income which is 4.5 crore, and since it is more than 2 crore, I need not apply the higher rate of surcharge of 25%, is because there is a specific exclusion that while deciding the applicability of the rate of surcharge, I need to exclude this capital gain falling under 111A and 112A, and therefore I'll calculate the surcharge at 15% on the tax liability which I computed on my other income, as well as my tax liability which I'm computing on the short-term capital gain as well as long-term capital gain at the specific rate of tax which is being provided under 111A as well as 112A. I'll continue to apply the surcharge at 15% irrespective of the amount of income. In my example, I have given that the amount of short-term capital gain is 1 crore. But even if let's assume that the short-term capital gain is only 10 lakhs, STT paid transaction, even in that case, the tax which I compute on this short-term capital gain, I need to apply surcharge of 15%, is because my total income is more than 2 crore, and therefore I need to compute the surcharge at the rate of 15% even with respect to my tax liability on this capital gain. This is what I wanted to clarify. And in the second example, if we just increase the amount of other income to 6 crore, that's the only change as compared to my first example. So instead of saying it is 1.5 crore, now I'm saying that my other income is 6 crore. So here, since my other income is now more than 5 crores, excluding the capital gain, I need to compute the surcharge at 37%, but only with respect to the tax liability which I compute on this other income. Whatever is the tax liability with respect to my capital gain falling under 111A or 112A, I'll not be increasing the rate of surcharge to 37%. I'll continue to apply the rate of surcharge of 15%, and therefore the incidence of the tax on this capital gain tax liability on this capital gain arising out of stock market transaction will not be increasing to that extent, and the surcharge will continue to apply only at 15% in this cases. So this is with something related to the changes in the rates of surcharge. And now coming to the corporate side, the whatever changes which have taken place with respect to the corporate taxation. So friends, mainly as I mentioned to you that there are two major changes, section 115 BAA and section 115 BAB. So section BAA provides the tax rate of 22% which will apply to any domestic company without applying any further conditions. It's a very simple provision, an optional scheme which is being provided. Of course, it is subject to some more condition on computation of income, which I'll come to little later. We have another provision which is 115 BAB, which provides the tax rate as low as 15% and which is applicable once again on only to domestic company, but provided this domestic company should be a new company for this purpose, and also it should be engaged into a manufacturing business for this purpose, and subject to so many other conditions which I'm going to deal with. So if you are able to satisfy those stringent conditions which have been provided in 115 BAB, the low rate of 15% is available to that particular company while computing the tax liability. If you are not able to satisfy those stringent conditions which have been provided in BAB, you have another option to go under BAA and pay the tax at 22% instead of paying the tax at a lower rate of 15%. So as a snapshot as to what has happened with respect to the tax rate of the corporates. So the existing tax rates depending upon the turnover of the company, and that too turnover of financial year 17-18, we had two categories, that is 30% and 25%. The large companies were subject to tax at 30%, and large company I mean those companies having turnover of more than 400 crore of the financial year 2017-18, they were subject to tax at 30%, and small companies, those companies not having turnover of more than 400 crore in financial year 17-18, for them the tax rate was 25%. And plus they were subject to surcharge, and surcharge was dependent upon the amount of total income of these companies. So if this company's amount of total income is more than 1 crore, they were subject to surcharge at 7%, and if the amount of income was more than 10 crore, they were subject to surcharge at 12%. These were the existing tax rates which were applicable for the corporate associates. And now you can see the change. This existing tax rate continues as it is, and the changes, they have been given an option to shift to the new tax regime either under 115 BAA or under section 115 BAB. So under BAA, they have an option to pay tax at 22% as I mentioned to you. And if you go under 115 BAB, you have an option to pay the tax at 15%. And when you go under this optional tax regime, either under BAA or BAB, these companies will be subject to a surcharge of flat rate of 10% irrespective of the amount. So under the existing tax regime, the surcharge was dependent upon the amount of income. And here, since the base rate itself has been reduced from 25 and 30% up to 22 and 15%, perhaps the surcharge has been levied at a flat rate of 10% irrespective of the amount of total income, which we need to understand. So before I go and analyze those two provisions, let me tell you a few important things. So both these provisions, 115 BAA and 115 BAB, have been incorporated in Chapter 12 of the Income Tax Act. And Chapter 12 of the Income Tax Act gives us several sections for determination of tax liability on in certain special cases. 111A, 112A. These are all sections which are part of Chapter 12. So both these new provisions have been incorporated in Chapter 12 of the Income Tax Act, and further they have been made subject to the other provision of Chapter 12 itself. So what do I mean by this? I mean that if these companies, even if they are exercising their option to pay the tax under this alternative new tax regime at either 22% under BAA or 15% under BAB, if they earn certain special incomes to which other provisions of Chapter 12 are applicable. So for instance, the company, new manufacturing company, has exercised the option to pay the tax at 15% under section 115 BAB. Now by any chance, if this domestic company has earned some short-term capital gain under 111A, the tax is to be computed under section 111A, and incidentally the tax rate there is also the same, which is 15%. But if they have earned some long-term capital gain under section 112A, in that case the tax is required to be computed on that long-term capital gain at 10%, because these new provisions are subject to the other provisions, namely 112A or 111A or even other provisions. And one more example is that if this company by any chance have been caught with undisclosed income, income from unexplained sources like section 68, 69, etc. In that case, do you think that this companies will be taxed only at 15% or 22%? Answer is no. It's because we have a special provision, that is section 115 BBE, which provides the tax rate of 60% on the income from unexplained sources arising out of section 68, etc. And therefore, if these are the income which have been assessed in the hands of these companies, even if they have opted for the 115 BAA or BAB, they will be taxed at such a higher rate of 60% on this particular amount of income as per the provision of section 115 BBE. And let me also clarify the applicability of the surcharge. And when I come to the applicability of the surcharge, even assuming that these companies have exercised the option to pay the tax under the new alternative tax regime, as I mentioned to you that the surcharge is 10% flat irrespective of the amount of income. But if we are computing the income of these companies, or rather we are computing the tax liability of the same companies under some other provisions and not under section 115 BAA or BAB, in that case, the normal rate of surcharge will apply and not the special rate of surcharge of 10%. I mean that if, continuing with the same example, the company which has opted for paying tax at 15% under 115 BAB, if this company has earned, for instance, some short-term capital gain which is taxable under section 111A, the tax rate remains the same, 15%. But the rate of surcharge will change and 10% surcharge will not apply. The normal rate of surcharge of 7% or 12% will apply with respect to this tax liability which we are computing under section 111A, provided the amount of income, amount of total income including that gain as well as the manufacturing business income, if the amount of total income is exceeding 1 crore or if it is exceeding 10 crore, depending upon this, the normal rate of surcharge of 7% or 12% will apply only with respect to the tax liability which we are computing under other special provisions of chapter 12. That is how one will have to compute the tax liability including surcharge of this company exercising this option. And therefore I was just wondering as to how the complicated the calculation will be for the companies, and I realized that there are now 12 different rates which are available, right from 4%, as low as 4%. 4% is the rate of cess which is available, and the peak rate is 60%, which is the one which I just talked about, 115 BBE. And there are total 12 different figures, 12 different rates, and one will have to adopt the appropriate combination of three rates, that is basic rate of tax and surcharge and cess, depending upon the type of the assessee, depending upon which option this assessee has exercised, depending upon the type of income which the assessee is earning. And might be possible that while filing the return of one and the same company and for the same assessment year, might be possible that you come across a situation where on different types of income you are calculating the tax at different rates and different surcharge is because of this particular provision. So one will have to be very, very careful while applying this rates of surcharge. So I was mentioning about those two provisions of 115 BAA and BAB, and I'll first deal with the second one, 115 BABs, is because that is something which is more interesting and appealing to the corporates. And therefore, let's try to understand the second provision first, and then I'll deal with BAA as well in the end. So coming to section 115 BAB, the rate of tax, as I mentioned, is 15% plus 10% surcharge and 4% cess, and therefore effective tax rate becomes 17.16%. It is applicable only to a domestic company, a new domestic company having a manufacturing business, and it is subject to some stringent conditions. And this is an option which is available. It is something which is not mandatorily required to be followed. And once the company is exercising this option to pay the tax under section 115 BAB, MAT provision under section 115 JB will never apply to this particular company. So this company will be out of the alternative mechanism to pay the tax under section 115 JB. So let's first deal with the eligibility. Who is eligible to exercise this option to pay the tax at such a low rate under section 115 BAB? First and foremost thing, it is only a domestic company which is eligible to exercise this option. So foreign companies are out of questions, and even non-corporate associates are out of questions. Domestic company, what is the size of that company? Whether the shares of this company are listed or not listed is nothing is relevant as far as BAB is concerned. The only condition is that it should be a domestic company. Number one. Number two, this company should be a new company. That means this company should have been incorporated on or after 1st of October 2019. So this announcement was made on 20th of September 2019, and perhaps therefore the date of 1st of October 2019 has been set, that only if the company is incorporated on or after 1st of October 2019, only in that case this company will be eligible to exercise this particular option. And there's one more date which is required to be kept in mind, and that other date is 31st of March 2023. And that is the deadline which is given to this company to commence their manufacturing business. So this company essentially should be a manufacturing company, and there is a deadline that you cannot just exercise this option and keep on delaying your manufacturing activity. You need to commence your manufacturing business on or before 31st of March 2023. So about 3.5 years is given to this company in order to commence their manufacturing activity. What are the permissible business? Here it is not a case where companies engage into any business can exercise this option of paying tax at just 15%. This particular incentive provision has been incorporated in order to promote this manufacturing segment of our economy where there is a slowdown. And therefore, this provision mentions that the permissible business of this domestic company, if at all they want to exercise this option, should be a manufacturing business. And if I just go to the wordings of this provision, it says that the company should not be engaged in any business other than business of manufacture or production of any article or thing. So if you are engaged in any business other than this business of manufacturing or producing any article or thing, in that case you will not be eligible to exercise this option. And please note that this condition will continue to apply to this company forever. It is not only that when you incorporate the company and when you first start your business, that should be a manufacturing business. It will continue to apply to this company forever as it stands today. And therefore, forever, the business of the company should be exclusively manufacturing or producing any article or thing. In addition to this, the provision mentions that if this company is also engaged into activities like research or distribution of this article or things which are manufactured or produced by that particular company, we are okay with that. This has been incorporated in the provision as if the research, if I do a research in this particular article or thing, or if I distribute this article or thing, it becomes a separate business and it cannot be considered as part and parcel of my manufacturing business. And that is how this provision has been incorporated. I'll deal with this particular activities a little later in more detail in the subsequent slide. But let's just first try to concentrate on this permissible business. Primarily, it should be a manufacturing or producing of any article or thing. And here we have 4 words. That is manufacture, production, article and thing. And what do we mean by this 4 words? Manufacture, production and article and thing is something which is very, very important. It's because out of these 4 words, you will find that only one word is defined under the Income Tax Act, that is manufacture. You find an exhaustive definition of manufacture in section 2, whereas other words, production, article or thing, are not being defined anywhere under the Income Tax Act. And therefore, that's where the complication is going to arise. And I want to deal with this particular concept of manufacture, production, article and thing in little more detail with the help of my subsequent slide. So first let me come to the meaning of manufacture. This becomes very important is because company needs to satisfy the test in order to become eligible for such a concessional rate of 17%. And if you don't satisfy the test, you will be out of this particular scheme of paying tax at such a low rate, and perhaps you will have to pay the tax at the normal rates which are applicable to the companies, that is 25% or 30%. And therefore it becomes very, very important for us to understand as to what is the meaning of manufacturing or producing article or thing. And at the end, you will realize that these four terms are very important in order to apply this in any practical scenario. So the meaning of the word manufacture, and I found that there was an old decision of Supreme Court in 1963, that is in the case of Delhi Cloth and General Mills Company Limited under the excise law. And here Supreme Court said that this meaning of manufacture, the definition under the Income Tax Act was incorporated later on in 2009. And in those days we were not having the definition of the word manufacture, and therefore Supreme Court explained this concept of manufacture, and Supreme Court came out with guidelines to understand the meaning of this word manufacture. And Supreme Court said here that two things are necessary in order to say that something has been manufactured. And what are these two things? There has to be a change. Because of the manufacturing process which you have carried on, it should have resulted into change. If there is no change which is taking place, it cannot be said as manufacturing at all. But merely because there is a change, it cannot be said that it is amounting to manufacture. So all manufacturing involves a change, but all change will never amount to a manufacture. And therefore Supreme Court said further that if the change is resulting into a transformation of something into a new and different article having distinct name, character or use, only in that case that change can be considered as manufacturing, and not the each and every change which is taking place. So you might apply labor, you might apply capital, you might employ machineries, you might use sophisticated machineries even for that matter, and you are making several changes in the product. But if the change which you have made is not transforming into a new product, a new article having distinct name and character and use, that particular change will never be considered as manufacturing for this purpose. This was the concept which was laid down by Supreme Court as in this case of Delhi Cloth and General Mills Company in 1963. Then I found that very recently, I mean in 2010, once again Supreme Court dealt with this concept of manufacturing in the case of Oracle Software India Limited. And here Supreme Court tried to make certain changes in this concept of manufacturing. And here this particular company, Oracle Software, as we all know that this company was engaged into development of softwares. And what this Indian company had done was that copy of the software which was available on a master media, which was being copied on CDs, and then this CDs having these copies of the software were being sold in the market. And the company argued before the court that this duplication process by which we copy this master copy of the software in this blank CD, this itself should be considered as amounting to manufacturing or producing article or thing. And here the department objected with this particular proposition which was being laid down before the Supreme Court by the taxpayer, on the simple ground that look at that old decision of Delhi Cloth and General Mill, and Supreme Court had said that manufacturing is a change which should result into transformation of something into a new article, new commodity having distinct name, character or use. And here in this particular activity of just duplicating software from one media to another media, there is a change, but where is that new article which is coming into existence? Even before the process which you had carried on, that software was being available, and even after the process which you have carried on, that process of duplication, the software continues to be the same. There is absolutely no change with respect to the software, with respect to any article or thing. And therefore department objected to this particular proposition which was being laid down before the Supreme Court. And here, perhaps for the first time in 2010, Supreme Court in its order said that with the time we need to change the meaning of the word manufacturing, and more particularly in the context of computer technology. And therefore Supreme Court disagreed with this view which was prevailing, that this manufacturing should always result into a new and distinct article or a commodity having different name, character or use. And here Supreme Court took the help of an American decision, a decision of an American court in the case of United States versus International Paint Company. And Supreme Court said that if any particular process which the SSE has carried out, if this process renders that particular article fit for use, which that otherwise that article was not capable of use. So I am carrying on a process, and before this process, that particular article was into existence, but it was not capable of use. And after the process which I have carried on, now this particular article is capable of use. In that particular case, the Supreme Court says that even in this particular case, this process should be considered as a manufacturing process, though no new article or thing is coming into existence. And therefore, there was a change with respect to the concept of a manufacturing process as the Supreme Court has understood and Supreme Court has laid down in these two decisions. But please note that subsequent to this decision, we have a statutory definition which is incorporated in our own Income Tax Act with effect from 1st of April 2009, and therefore whatever I discussed with respect to that decision of Oracle Software, one need to understand now the implication of this Supreme Court observation in light of this definition which is now available under the Act. And this definition, we found this definition in 229BA, and this definition, it says that manufacturing means what? It gives an exhaustive meaning to the word manufacturing, doesn't give an inclusive meaning. It says that manufacturing means, and therefore what we understand from this definition is that this is an exhaustive definition and not an inclusive definition. And it says that manufacturing means, once again, a change. And which change? The change which is resulting into a transformation of one object into another object having different name, character and use. And therefore this definition is exactly going on the line of that old decision of Supreme Court in 1963 in the case of Delhi Cloth and General Mills, that there has to be a change, and this change should result into a transformation whereby a new article or new commodity is coming into existence which is having a different name, character or use. And the concepts which were being laid down by Supreme Court in the case of Oracle is perhaps not being incorporated in this particular definition, whereby even if it is not resulting into an existence of new article, but if this process is helping that article to become fit for market, even in that case, whether it can be considered as manufacturing or not, that is something which is not coming out of this definition. And therefore what I found is, from this definition of manufacturing is two important things. One is that it refers to a change in a non-living object, article or thing, and therefore anything and everything with respect to living article or thing is not being considered as manufacture, at least in this definition as we have now in section 229BA. And second, that change upon a non-living thing should result into a new article or thing having different name, character or use, as I mentioned to you. So before I proceed further, in order to understand the meaning and analysis of this particular definition, I thought of two simple examples which we come across in our daily life. Number one, we come across a street vendor selling coconut waters. It brings the coconut, and after cutting this coconut, he sells the coconut water to us. Whether this particular process which is he doing, whether it is resulting into a manufacturing of any new article having different name, character and use. An answer perhaps to this question is no. Am I right? The answer perhaps to this question is no, is because that coconut water was already into existence even prior to this process which was being carried out by that vendor, and therefore this particular process is not resulting into an new article or thing coming into existence merely because of this, and therefore perhaps this activity cannot be considered as manufacturing, at least for this purpose. The second example which we come across is a tailor providing services. From clothes he is making the ready-made garments. Can it be said that this is a manufacturing activity? Because of this particular process which he is carried on this, from clothes he is making the ready-made garments, and these commodities which have been produced or which have been manufactured by that particular person is having different name, character and use. The use is different, character is different and name is also different, and therefore certainly this particular activity can be considered as manufacturing activity as far as this definition is concerned. And keeping these two simple examples in our mind, let us further try to understand what will be the implication. Yeah. Yeah, I am coming to that. I have and yeah, I am not aware about this press note, but I have included some of the important points with respect to this software as well. Okay. Okay. So now, having understood the meaning of the word manufacture, let me remind you that the section 115 BAB, the wordings of this section is not only manufacturing article or thing, it says manufacture or production of article or thing, and therefore we have in alternative the word production. And therefore the question arises here is that whether the meaning of manufacturing and production, whether these two are same or these two have different meaning. An answer to this question I found in a Supreme Court decision, an old decision which is in the case of NC Budharaja and Company. In 1993, Supreme Court dealt with this, both this words, manufacture and production, and Supreme Court held that both of these words have different meaning. The term production is more wide as compared to the word manufacturing. And it further said that if by any process, if a new goods or new article with different name, character and use is coming into existence, but that process cannot be considered as a manufacture, in that case it can be said that this particular article or thing has been produced, though not manufactured. And therefore, which is that process which cannot be considered as manufacture, but it can be considered as production? That question still remains. And I'll try to deal with this particular question in the subsequent slide. But what we understand from the Supreme Court decision in the case of NC Buddha Raja is that underlying principle remains the same, and underlying principle is that whether you say it is manufacturing or you say it is production, what is relevant is that because of this manufacturing or production, new article or thing having different name, character and use should come in existence. If it is that primary condition is not satisfied, perhaps it will be difficult for us to say that this is a manufacturing activity or this is a production activity, subject to that Supreme Court decision in the case of Oracle software, which I have just dealt with. And therefore, I found then later on couple of decisions of Supreme Court. For the first one, which was in the case of Sesa Goa Limited, and here the SSE was engaged into an activity of mining of ores, and the question arose that whether all this decision which I am discussing is mainly under Income Tax Act and mainly in the context of the tax holiday which were available under Chapter 6A with respect to manufacturing activity, where the words used were same, manufacture or production of article or thing. So that particular industrial undertaking or a unit should have been engaged into this activity of manufacturing, production or production of article or thing. And in the context of this provisions under the Income Tax Act, all these issues were arising, and this is how the Supreme Courts or High Courts have dealt with these issues, which I have incorporated in my slide. So here in this case of Sesa Goa, once again that issue arose that whether this activity of mining, can it be considered as manufacturing or production? And here Supreme Court answered that though it cannot be considered as manufacturing process, but certainly it can be considered as a production. And because these two terms are given in alternative, if the activity fits within the meaning of the word production, the SSE should be granted those particular tax benefits which were available to that SSE under Chapter 6A. And here Supreme Court made a distinction with respect to the meaning of the word production, and Supreme Court said that it is not necessary that this mined ore should be a commercially new product. The department argument was that where is that concept which is getting satisfied in this activity, the concept about coming into existence of a new article or thing because of this process. And department argued that these products were already available in the mines, and what the SSE has done is merely extraction of this product which were already in existence, nothing else. And therefore, as a counter argument to the Supreme Court held that it is not necessary that as far as the production activity is concerned that a new article or thing should come into existence. Even if these products were already available, still the activity is falling within the meaning of the word production, and therefore the benefits with respect to this production activity as available under Chapter 6A should have been granted. And once again, this has been confirmed by Supreme Court as let us in 2009 in Vijay Ship Breaking Corporation. And here the activity of SSE, as name suggests, was ship breaking activity. And the ship was already into existence, and because of the ship breaking activity, several articles which were available within the ship were being extracted separately. And once again, the same argument from the department that here nothing new which is coming into existence. All these goods and articles were already in existence even prior to this activity of ship breaking. And once again, Supreme Court confirmed that even the ship breaking activity amounts to production of article or thing, though not manufacturing. And here what is happening is that the distinct article and thing is coming into existence. Prior to this activity, it was a ship, and after this particular activity of ship breaking, several different articles which are distinct from ship are coming into existence, though not new, but at least distinct article and thing which are coming into existence, and therefore this activity should be regarded as production activity entitled for the benefit of tax holiday. So in later cases, the Supreme Court is coming out with the concept that at least for production activity, though new article or thing is not coming into existence, but the activity is such that the distinct article and thing is coming into existence, this particular benefit is required to be granted. One more with respect to production which reached to Supreme Court in the case of Venkateshwara Hatcheries Private Limited, and here the activity of SSE was it was running a hatchery, and the tax holiday benefits were being claimed. And here once again the same issue arose as to whether this activity can it be considered as a production activity. The SSE was arguing that what we are doing is that we are producing chickens, and therefore we should be granted this particular benefit under the respective tax holiday provisions. And here Supreme Court said that agreed with respect to those concepts of manufacturing or production, but at least in your activity, no new article or thing is coming into existence because of the efforts which were taken by the SSE. And therefore, it cannot be said that it is the SSE who is producing this article or thing. Number one is because it is a natural process, and the natural process is that from egg the chicks come, and therefore it is not the SSE who is enabling this activity. It is a natural process. The only difference is that it has been carried out, this particular activity has been carried out in a more appropriate manner with lesser mortality rate and high production, that's all. But otherwise it's a natural process which a human being cannot interfere with, and therefore this particular activity, it cannot be said that the SSE is producing this chicken. And moreover, Supreme Court here said that this living beings, this chickens, etc., cannot be considered as article or thing, at least for this purpose of manufacture or production of article or thing. And therefore, it is going on the same line as we have the definition of manufacturing under the Income Tax Act as we discussed. So this was something with respect to the distinction between manufacturing and production. Now, third question which can arise is that whether processing can be considered as manufacturing or production. So we have three terms, that is manufacturing, production and processing. And 115 BAB uses only two terms, that is manufacturing or production of article or thing. It doesn't talk about processing of article or thing. And therefore the SSE who is merely engaged into activity of just processing something, whether it can be said that it is manufacturing or producing new article or thing, and therefore this particular benefit of paying tax at a lower rate under 115 BAB is available to that SSE or not. An answer to this question is available in this decision of Bombay High Court in the case of Sterling Foods, which was later on being approved by Supreme Court in the case of Release Foods. And here the activity of the SSE company was processing of shrimps and prawns, and it was being claimed that we are engaged into this producing activity, and therefore we should be granted this particular benefit of tax holiday. And here Bombay High Court more particularly dealt with the meaning of all three terms as to what is manufacturing, what is production and what is processing. And Bombay High Court held that processing involves a change, but that change is not capable of bringing a new article or thing into existence. And therefore, whatever activity which you have carried on, whatever processing which you have carried on, at the end of your processing, if the article or thing is substantially the same as it was before, in that case, it cannot be considered that you are manufacturing or producing this article or thing, because the old article and new article in substance is remaining the same. And therefore, here Bombay High Court held that this shrimps and prawns earlier were raw and now it is just merely a processed and finished. It cannot change the name, character and use of this article, and therefore it cannot be said that you are engaged into a manufacturing and producing activity, and therefore all this only mere processing activity with respect to the fish and other sea products will not be entitled to be called as manufacturing or producing activity. So this was something with respect to the meaning of this manufacturing, producing and processing. Now, one more question which may arise is that, agreed that I am engaged into this activity of manufacturing or producing any article or thing, but the facts are such that I am manufacturing or producing this article or thing not for me but for others. That is mainly job work basis. So I am merely a job worker. Whether I am entitled to claim these benefits of an optional scheme of paying tax at 15% under section 115 BAB. An answer to this question depends on the facts of each case, is because what is important is that the process which you are carrying on, whether for on your own or for somebody else, that process should result into a new article or a thing. Only in that case it will be considered as a manufacturing or production activity and not otherwise. It is irrelevant whether you are manufacturing or producing this article or thing for your own use or for somebody else or on behalf of someone else. And therefore, I found that right from Supreme Court and High Court, these are the landmark decisions. The first one was in the case of Supreme Court, in the case of Ujargar prints, in the context of the excise law, where the jobbers were engaged in this activity with respect to the grey fabrics, that is bleaching, dyeing, etc. And the question arose that whether this activity of jobbers, can it be considered as a manufacturing activity? And there Supreme Court held that yes, certainly yes, because it is bringing some new article or thing, and merely because these grey clothes have been supplied by others and on this material supplied by others this activity is being carried on, it cannot be said that it is not resulting into manufacturing or production activity. It was followed by a Madras High Court decision in the case of Tej. There are a number of other decisions, but the important one which I have captured in my slide. So in this Madras High Court decision in the case of Tej Fireworks Industries, the SSE was manufacturing the fireworks on a job work basis for others on the raw materials which were also supplied by the other parties, and even in this facts it was being held by the Madras High Court that this particular benefit of tax holiday under chapter 6 should be granted to this SSE. It is not necessary that you should manufacture or produce this article or thing on your own behalf and not for someone else. The other incidental question which can arise is that I am a manufacturing unit, but at the same time I am getting some of the goods manufactured through others. Outsourcing, what we say is that on the other side. So whether this principal manufacturing, the principal person engaged in this manufacturing activity, whether that person is entitled for this particular benefit or not. An answer to this question is that we have a landmark decision which is in the case of Calcutta, in the case of A. Mukherjee and Company by Calcutta High Court. And here we need to study the facts of this particular case, and here the case was that the SSE was a publisher of books. The idea of a particular topic on which the book should be published, conceptualizing these topics, getting the authors, getting the content, and doing everything with respect to this books was being done by this particular publisher. The only activity outsourced by the publisher was printing of books and binding of books, is because the printing press was not owned by this publisher. And here it was being claimed that the SSE is engaged into producing of these books, and to which department objected is that the main activity with respect to this books, that is printing and binding, you have not carried on, and you have outsourced this activity of printing and binding of books to someone else, and therefore you are not engaged into a manufacturing or a production activity. And here Calcutta High Court held that this outsource activity was only with respect to printing and binding of books, whereas all other activity which I have mentioned was being carried on by this particular SSE, and therefore it is the publisher, this SSE being a publisher of the books, was engaged into a manufacturing or production activity, and it is not that contractor to which this activity of printing and binding was being outsourced, and the benefit should be given to this principal SSE being a publisher of the books, and this view was being followed thereafter thereafter by CBDT by expressly in the circular number 347, which was issued in 1982, conforming with the view of this Calcutta High Court. And therefore what we need to understand is that if all the activities with respect to manufacturing and production of goods have been outsourced to someone else, then you are not entitled to be called as a manufacturer or producer. But it is only some of the activities which have been outsourced, and principally, predominantly, all other activities have been carried on by you. In that case, you are entitled to be called as a manufacturer or producer of this article or thing. And that is what is coming out from even from Supreme Court decision, which I have included in my slide. I am not discussing the facts of the Supreme Court decision once again in more detail, which is in the case of chilies exports house. They were engaged in the activity of exporting chilies, and here Supreme Court held that if only one of the activity has been outsourced, it will not be detrimental to claiming the tax holiday under Chapter 6A. It cannot be said that the principal assessee is now not engaged into manufacturing and production activities because this only one activity has been outsourced. So if principally mainly all other activities have been carried on by you, but only some of the activities have been outsourced, it is not detrimental to be for becoming entitled for this tax holiday or now 115BAB, taking the same view forward. So having understood the meaning of these terms, that is manufacturing and production, let me come to the other two important terms, terms which are article or thing, and you will realize that even with respect to this meaning of article or thing, the disputes have reached up to Supreme Court. And before I discuss this, several nuances with respect to the meaning of the term article or thing, let me tell you that as far as 115BAB is concerned, there is no restriction on the type of article or thing. As long as you are engaged into manufacturing or production of article or thing, let it be any article or thing, whether it is in the benefit of the society or not, irrespective of this, the concessional tax rate of 15% under 115BAB is available. Whereas under several other provisions under the Income Tax Act, we have a negative list that manufacturing or production of article or thing, excluding some of the article or thing which have been listed in some of the specific schedule to the Income Tax Act. So such a negative list has not been incorporated under the provision of 115BAB. So article or thing, the first decision which was of Supreme Court in the case of NC Budharaja and Company, which I had just referred in my earlier slide, and here the question arose that this particular company had constructed a dam, and this company was claiming some of the benefits which were available only with respect to the activity of manufacturing and production of article or thing. And the issue was that whether this dam which was being constructed by this company, can it be considered as an article or thing? And here Supreme Court said that sorry, it is only movable properties which can be considered as an article or thing. It cannot be said that you have manufactured dam or you have produced this dam. What you have done is that you have just constructed this dam. And therefore this article or thing, it has these terms have been used with these terms of manufacturing and production, and therefore it is not possible to say that immovable properties have been manufactured or produced, and therefore this article or thing necessarily refers only to movable article or thing, and immovable article or thing or immovable objects cannot be considered as falling within the scope of this manufacturing or production of article or thing. And therefore what we understand from this decision of Supreme Court is that the construction activity, those domestic company engage into construction activity, including construction of buildings, etc., perhaps will not be entitled for opting under section 115BAB to pay the tax at a concessional rate of 15%. It is a different matter that nowadays even the immovable things have become movable. We see that when we have read the stories that even the immovable properties which were considered to be immovable traditionally, there is a incidents which have taken place that where the entire thing has been lifted and has been shifted to some other place, and therefore leaving aside those concepts, the construction activity will not be entitled for taking this benefit of 115BAB. Delhi High Court was concerned in the case of Radio Today Broadcasting Limited with respect to intangible thing, and the question was that in this case the company was engaged into producing of radio programs for FM channel. And therefore the question was that this radio programs being intangibles, whether it can be said that they are manufacturing or producing, not manufacturing, but whether they are producing this article or thing. And the question was that whether intangible products can be included within the meaning of this article or thing. And here Delhi High Court said that yes, if you read the dictionary meaning of the word thing, it also refers to intangibles, and therefore even intangible products are also should be considered as article or thing, and therefore this particular benefit with respect to the activity of manufacturing or production of article or thing was being granted to this particular SSE engaged into the business of producing radio programs. And the recent decision of once again of Delhi High Court, which is in the case of NTPC Sale Power Company Limited, where it was held that even electricity for the purpose of income tax should be considered as an article or thing, and therefore SSEs engaged into generation of power electricity should also be entitled for the incidental benefit with respect to this manufacturing and production. Someone was referring to a computer software. So whether this computer software, can it be considered as an article or thing? The issue may also arise that whether it can be considered as a manufacturing or production process. But the other issue is that whether the computer software can be considered as an article or thing, that is also an issue. What I found is that we have other provisions under the Income Tax Act, that is 10A, 10B, and there if you read the provision, they are very specific. There they say article or thing or computer software. The computer software has been specifically referred in addition to reference to the article or thing, and perhaps therefore indirectly the meaning is that the article or thing cannot include the computer software, and therefore there was a need to refer computer software specifically in those provisions of 10A, 10B, and therefore can it be said that this computer software, though intangibles are otherwise covered, but computer software is merely just a set of commands, and therefore it cannot be considered as an article or thing? For this purpose, this issue will remain. We don't have any specific answer with respect to this particular issue as of now. Then the other issue which can arise is, surprisingly, is that whether the benefit which is available to a domestic company, agreed, but what if the domestic company is setting up a manufacturing unit outside India? Whether this domestic company is setting up a manufacturing unit outside India, whether even this company is also entitled for a concessional rate of 15% under BAB? The answer is that if you read the press release, it specifically provides that it is in order to promote Make in India concept, we are coming out with this proposal of lower rate of tax of 15% with the introduction of a new provision, section 115 BAB. But if you read the provision of section 115 BAB, you will never find anywhere a condition that the manufacturing unit should have been set up only within India in order to become entitled for this particular provision. And therefore, in the absence of any such particular condition in the provision, perhaps a view is possible that even a domestic company, even if they are setting up a manufacturing unit outside India, as long as their business is restricted only to a manufacturing or a production business, they should be entitled for this particular concessional rate of tax under 115 BAB. I know that it is not much practical, is because if you set up a manufacturing facility outside India in that other country, there will be a tax incidence which can be even more than 15% which you pay here under BAB, and therefore it's just a theoretical one. Is it necessary to have machineries in order to say that I am engaged into a manufacturing or a production activity? A very basic question. And the answer to this question I found in a Bombay High Court decision in the case of Unique Gem and Jewelry, a very recent decision of 2019, and Bombay High Court said that merely because you have machineries, you cannot claim that you are engaged into a manufacturing or a production process. And if you are otherwise engaged into a manufacturing or a production process, it is not necessary for you to have machineries. And here in the facts of this case, the SSE was engaged in preparing diamond studded jewelry, handmade jewelries, without taking any help of the machineries. And the benefit of tax holiday was being granted to this SSE by Bombay High Court, and department was objecting that if you look at your balance sheet, you don't have any plant and machinery in your assets, and therefore how can you claim that you are engaged into a manufacturing or a production process? Yes, sir. So that Oracle software decision which I was just referring, in that particular Supreme Court decision, they had very categorically said that whatever we have laid down is only with respect to duplication of the master copy of the software. And they were referring to another decision of Supreme Court in the case of TCS, which was in the context of some other act. And by making a reference to that TCS, it was discussed in that Supreme Court decision in the case of Oracle software that moment it is being copied to another media, it becomes goods. So that's where perhaps a distinction has been drawn by Supreme Court in the case of Oracle software. So having discussed all this landmark decision of Supreme Court and High Court, I have a couple of more slides to discuss where you will find that the facts, majority of the facts are similar, but only a small difference in fact is making a lot of difference as far as the end conclusion is concerned. So the first one is with respect to the activity of mining and some further processing activity which have been carried on. So the first decision of 2000 by Supreme Court, which was in the case of Lucky Minerals, Supreme Court held that this mining of limestones and marble blocks and thereafter cutting them in appropriate sizes, it cannot be considered that you are engaged into a manufacturing or a production process. Then it was being followed by a Sesagova decision which I had just referred, and there Supreme Court in 2004 held that mining activity is also required to be considered as a production activity. There is no need to have a new product coming into existence because of this mining activity, and that is where the difference is being created. And thereafter we have a latest decision of Supreme Court in 2010 with respect to a similar activity, and there Supreme Court held that here the SS is not only engaged into an activity of mining, but the marble blocks have been thereafter converted into marble slabs and tiles which were polished one. And therefore if you see the end product, it has a different utility, different market as compared to the raw marble which was being extracted from mines, and therefore distinction was being drawn by Supreme Court as compared to the earlier decision of 2000 in the case of Lucky Minerals, and it was held that this particular assessee should be given the benefit of tax holiday with respect to a manufacturing or a production activity. So the activity of polishing made a difference as far as these marbles were concerned. But the same activity of polishing with respect to diamonds, the assessee lost the case before Supreme Court in the case of Gem India Manufacturing. And here Supreme Court held that cutting and polishing of diamonds, so conversion of a rough diamond into a polished diamond, cannot be considered as a production activity, is because after all it is a diamond, whether you call it as a rough diamond or whether you call it as a polished diamond. Only the difference is there is a value addition, there is some processing, but that process is not resulting into a transformation into a new product, and therefore the benefit of tax holiday was being denied by Supreme Court to this particular assessee. I'll be failing in my duty if I don't point out that there is a specific explanation 4 to section 10b which specifically provides that this activity of cutting and polishing of diamond will be regarded as manufacturing or production activity, but only for the purpose of section 10b. And therefore the very fact that there is a specific explanation providing for this, perhaps it indirectly implies that it was otherwise not possible to consider this activity of cutting and polishing of diamond as a manufacturing activity. Then we have another Supreme Court decision which is in the case of Hindustan Petroleum Corporation, where the SSE was just engaged into an activity of bottling the LPG gas into cylinders, no other activity. And the department objected that this cannot be considered as a production activity or a manufacturing activities because the LPG was otherwise available, the cylinders were also otherwise available. Both of these have been procured by the SSE, and the SSE is just doing the activity which should be considered as something similar to a packing activity, and we all know that this packing and repacking cannot be considered as a manufacturing activity, at least for the purpose of income tax. And therefore department objected to this particular tax benefits which were being availed. But here Supreme Court said that this bottling of this LPG gas into cylinder brings a new product into existence, and that is called as gas cylinder. So empty cylinder has a different utility. The LPG which is not bottled in cylinder has no utility as far as the kitchens are concerned. And therefore by doing this activity of bottling this LPG into cylinder, a new product is coming into existence, and that is where it is creating a difference, and therefore that particular benefit was being granted. Some of the other decisions I'll just skip. With respect to films, two decisions of the High Court. One says that the production of cinematograph film is amounting to a production activity. Another High Court is saying that merely exhibition of these films in theater, it is not amounting to a production activity, and therefore this benefit should not be granted. Somebody was referring to this water. So we have one decision from Ahmedabad Tribunal which is in the case of Aqua Minerals, and here the SSE was engaged into this activity of processing on waters, purifying this and removing some of the minerals and then bottling this water and then selling this water bottles. And it was being claimed that what we are doing is that we are producing the water bottles, and it was also being claimed that it has different character, name and use. But here Ahmedabad tribunal disagreed with this particular contention of the SSE on the ground that the water remains the water. Whether it is a tap water or whether it is a water which is packed in this bottle, it is still a water, and therefore only thing is that there might be some value addition to this water. It can be considered as a water in a better form or a superior water, but ultimately it still remains the water, and therefore no new product is coming into existence. The SSE was arguing that what we are doing is that we are making available safe drinking water, and to this the tribunal objected that, do you mean that this tap water cannot be considered as a safe drinking water? The answer is no. So here, merely because you are carrying on some activity of purifying this water and then putting them in bottles and then selling this water bottles, it cannot be said that you are engaged into some manufacturing or production activity. This benefit should not be granted. Two more decisions to discuss. The one is in the Supreme Court in the case of Indian hotels. So this SSE was engaged in primarily in the business of hotel, and it had kitchen also, and the foodstuffs were prepared in this kitchen for the guest at hotel and even for the flights. And the benefits were claimed by claiming that it is a production activity or a manufacturing activity. And here Supreme Court disagreed with this particular proposition, and Supreme Court held that it can be merely considered as processing, but it cannot be considered as a manufacturing or production activity. And therefore what you can say is that the raw materials, that is flours and all, it has been merely produced in a more appropriate or an eatable form, that's all. It is not amounting to a production or a manufacturing activity. That was being held by Supreme Court, apart from several other issues which were there in the Supreme Court decision. Now the same activity, if you see a difference in the second decision in my slide, Ahmedabad Tribunal, which is in the case of Deep Kiran Foods Private Limited. And here also the SSE was engaged into a similar activity. What were the activities of the SSE? The SSE was producing or preparing rather the eatable items like paratha, samosa and dokla, etc. And the tax holiday benefit was being claimed. And department denied this tax holiday benefit, relying on that Supreme Court decision which I just discussed in the case of Indian hotels. And here Ahmedabad Tribunal in this facts of this case agreed that yes, it is resulting into a manufacturing or a production activity. And a distinction was drawn from a Supreme Court decision on the ground that in that Supreme Court decision the SS's primary business was to run a hotel, not to manufacture or produce this food stuff. And this eatable items were merely being produced as an incidental activity incidental to running of hotel, and therefore it cannot be said that the business of the SSE was manufacturing or production of article or thing in the facts of this case. But here the SSE was exclusively engaged in producing these eatable items, and therefore here the products having different name, character and use is coming into existence. When you prepare parathas, you cannot say that what you are selling is merely flour and ghee. What you are selling is parathas, and therefore it is something which is different from the raw material, and therefore it is amounting to a manufacturing or a production activity. And that is how this particular interpretation was being laid down by Ahmedabad Tribunal in this case of Deep Kiran Foods. And therefore at the end, what I realized after doing research is, perhaps in lighter words, that I was even better off as compared to research which was being done. And what I found is that even Supreme Court in this case of Ujagar Paints, which was a decision of 5 judges bench, and Supreme Court also agreed that the principles are very simple, that manufacturing activity is that activity because of which a new article or thing should come in existence. But here a bench of 5 judges in Ujagar Prints have reproduced the extract from the Supreme Court decision, and Supreme Court also agreed that it is very difficult to apply this in real life cases. And even Supreme Court further said that there might be borderline cases where either conclusion with equal justification may be reached, that whether it is amounting to a manufacturing or production activity or it is not amounting to a manufacturing or production activity. And therefore basically it will depend on the facts of each case, how you put up the matter before the authorities, that whether we are carrying on a manufacturing or production activity, and depending upon the both of this, perhaps a conclusion can be drawn that whether you are entitled for this benefit of 115 BAB or not. Having discussed these concepts of what is manufacturing, what is production, what is article and what is thing, Let me move on further. And the next issue is that you need to commence a manufacturing activity prior to 31st of March 2023. So 3.5 years window available for commencing this activity. And when you see the provision, as far as this deadline is concerned, this deadline is referred only with reference to manufacturing activity. Production word is not used there, but I feel that it is implied that either manufacturing or production, it should commence prior to 31st of March 2023. Now, with respect to even this deadline, some of the issues can arise, like whether a trial production or a commercial production, which one is required to be seen as far as the deadline is concerned. And it is very clear there are several decisions which says that it is the commercial production which is required to be seen. Is because when you have a trial production, you are not absolutely ready. You are testing whether you are fit for launching or not, and therefore such deadlines will go with respect to the commercial production, but not with respect to the trial production. There are some of the other issues which may not be which may not arise in common cases, and therefore I'll just skip some of them. These are available in my slides. Now, referring to those other activity, incidental activity, as I mentioned in the earlier slide, that 115 BAB allows me to carry on a manufacturing or production business, and it further says that you are also allowed to carry on research or distribution of those only those articles or things which you have manufactured or produced. So does it mean that I am not allowed to carry on any other incidental activities? There might be several incidental activities. Some of the examples I have given in my slides. I may provide after sales services. I may provide AMCs. I may provide the installation and training services with respect to those articles or things which I have manufactured. So does it mean that I am not allowed to carry on any other incidental activities with respect to my manufacturing business except for the research and distribution which are being specifically referred in the provisions of section 115 BAB? Answer to my mind perhaps is available in a Supreme Court decision in the case of Ashok Leyland, and here this company was engaged in manufacturing automobiles, trucks, and some of the spare parts were being imported and then sold. Those spare parts were not being manufactured by the SSE itself. And here Supreme Court said that you cannot isolate this activity of importing spare parts and then selling to the customer from the core business of manufacturing, and therefore you cannot deny the benefit with respect to even this activity of importing and then selling, because these are composite activity. You cannot disassociate this activity of importing then further selling from the main manufacturing activity. So this benefit can be taken from a Supreme Court decision. So anything and everything which is incidental or complementary to my manufacturing activity, I should be allowed to carry on. On a safer side, one can take a position that you can have a different entity altogether which might engage into all other incidental activity which are required to be carried on in order to avoid any complication. That's a different matter, but otherwise it should be allowed to carry on. Then further condition, section 115 BAB says that this company should not have been formed by splitting up or reconstruction of the existing business. If you have done it, that means you are just a same person having different clothes, and therefore you are not entitled for this concessional rate of tax under 115 BAB. What is the splitting up and what is reconstruction is something which is not defined in the Act. Though these are not defined in the Act, but we have some of the Supreme Court decision, and I'll just tell you the conclusion of the Supreme Court decision with the help of the examples. So the first one in the case of Textile Machinery Corporation Limited, and here the SSE had done backward integration. The raw materials which were otherwise purchased from the other parties, now the company set up a new unit for manufacturing the raw materials which were required by its main unit, which was otherwise functional. So whether a new unit set up for backward integration, production of raw material, can it be said that it is just a reconstruction? Supreme Court said that no, it is not a reconstruction, it is an expansion. And expansion cannot be considered as a reconstruction. One more Supreme Court decision in the case of Indian Aluminium Company Limited, where once again there was an expansion, and here the facts were that new unit was producing the same goods identical which were already otherwise manufactured by the existing unit. Here also Supreme Court said that as long as it's altogether a different unit which can function independent of the existing unit, the benefit cannot be denied. What if you are using the premises which are already being used by the existing entity? You have set up a new company, you are commencing a manufacturing activity, but in the same premises which were being used even otherwise by some other entity within the group. Are you entitled for this benefit? The answer is yes. You have a Bombay High Court decision. It says that merely because you are using the same premises, it should not be considered as a violation of the condition. As long as you are a new company commencing new manufacturing activity, you should be entitled for availing the benefits of 115 BAB. Then we have one more restriction, and that restriction, it says that this eligible company should not use any machinery or plant which are previously used for any purposes. There are two exceptions to this. Before I go to the exceptions, let me deal with this restriction in more detail, is because this is something which is very, very important. And when you look at this restriction, you will realize that there is a difference in the language which is being employed. We have a similar restriction even in chapter 6a, some of the sections like ATIA, IB, etc. But here, this condition which is otherwise similar has different wordings. And what are the differences in wording? The existing provisions of chapter 6a, it says that it is not formed by the transfer to a new business of machinery or plant previously used for any purpose. So this condition with respect to second-hand plant or machinery goes with respect to formation of that particular entity or the unit which wants to claim this tax holiday. Whereas in 115 BAB, it says that this company doesn't use any machinery or plant which is previously used for any purpose. And therefore, you will notice a substantial difference between the wordings of both these provisions. The first existing condition under the existing provision goes only with formation, and we had Supreme Court decision which is in the case of Bajaj Tempo, which categorically said that the after formation or the transfer of second-hand plant and machinery had no relevance with the formation. In that case, it cannot be considered as a violation of the condition. But now we have more stringent condition, and this condition says that we are not allowed to use any machinery or plant which were previously used for any purpose. Further, the issue may arise as to whether this condition goes with respect to any plant or machinery, whether I am owning this plant or machinery or whether I have taken this plant or machinery on lease. Is because the wording says that it doesn't use. The wording is not that it doesn't own. And therefore, the plant and machinery which are not owned by this manufacturing company, only these plant and machineries have been taken on lease for the purpose of manufacturing activity. But if this leased plant and machinery were second-hand plant and machinery, whether I'll be losing the benefits of 115 BAB, that's where the issue is going to arise. And since the wordings are more broad as compared to the wordings under the existing provision, I am sure that even this will apply to the plant and machineries which have been taken on lease for the purpose of carrying on this manufacturing or production activity. The other issue which can arise is that whether this condition will apply only to those plant or machineries which are used for my core activity of manufacturing or production, or it will apply to any machinery or plant whether I am using it for manufacturing activity or for some other purposes. Because under the Income Tax Act, we have a very broad definition of the term plant. Even this laptop can be considered as a machinery or plant for the purpose of Income Tax Act. So for example, if I am buying a second-hand laptop or I am buying a second-hand vehicle in that company, will I be losing this benefit of 115 BAB on the ground that I am using now machinery or plant which is second-hand plant or machinery? To this issue, we don't have any specific answer under the provision, but the contextual interpretation requires that this condition should be restricted only to those machinery or plant which I am using for the purpose of my manufacturing or production activity, and not to any machinery or plant which I am using for some other incidental activity which I have carried on. However, it is not free from doubt. A similar restriction is also applicable with respect to usage of building. Now, surprisingly, it further says that it is not only a plant and machinery, but it says that this company should not use any building which is previously used as a hotel or convention center. Now, this is something which is not realistic to my mind. Is because now if this company is buying some premises, now company will have to make an inquiry that whether this premises or this building which this company is proposing to buy, whether in past at any point of time, whether anyone had used this particular building as a hotel or convention center or not. And if this have been used, and if I am now using this building for my activity, I'll be losing this benefit of 115 BAB. It's practically not possible to go into such facts as to who and for what purpose this building was used by someone else in the past. However, fortunately, this hotel or convention center, it doesn't mean any hotel or a convention center. It says that this hotel and convention center is those which are defined in ATID. So mainly the hotels 2-star or above category and convention center satisfying some of the prescribed conditions which have been laid down in Rule 18DE. Once again, the issue which is going to arise here is that, for instance, the company is utilizing the services of hotels for the purpose of conducting, say, for example, conference for their employees or distributors. So they have organized a conference of the distributor in a 3-star hotel. Can it be said that this company will now lose the benefit of 115 BABs because this company is now using this building which is used as a hotel, and company is not allowed to touch the hotel forever? Answer to that question to my mind is no. Mainly because, as I had mentioned to you in the previous condition, usage of plant and machinery, it should go only with respect to those plant and machineries which I am using for the purpose of my core activity of manufacturing and production, and not with respect to any other activity. So similarly here also, this restriction on usage of building should go with respect to that building which I am using for the purpose of my manufacturing or production activity, and not for each and every activity which I have carried on, which cannot be considered as part and parcel of my manufacturing activity, number one. And second, if we carefully read this wording, it says that restriction is on use of any building previously used as a hotel or convention center. That means currently it is not used as a hotel or convention center. That is what I derive a meaning from these words. It should have been previously used and not today, as on today, and therefore perhaps this issue should not arise as far as the restriction on usage of any building is concerned. Yes. Yes. So as long as you are able to satisfy all the other conditions, you should continue to be eligible for the purpose of availing this tax benefits. And what time? Okay. So these were the important conditions with respect to BAB. Now let me come to the computation part. BAB says that since we are giving you the benefit of a concessional rate of tax that is 15%, you need to compute the income in this particular manner. So the computation of income will change for this purpose, and what are the changes which are going to take place, and this will equally apply to 115 BAA as well, whatever I discuss in this particular slide. So it says that some of the specified deductions you are not permitted to claim them. I'll come to that list of the specified deductions. Those income based deductions and the investment based deductions which are available under several sections of the Income Tax Act have been denied. Further, it says that if there is a loss which is arising purely due to these deductions which have been claimed in the past, this particular loss you are not entitled to set it off against your total income in this year, and it will be deemed that your loss is fully utilized and no further benefit of this loss will be given to you in future ever. As far as depreciation is concerned, it says that it will be mandatory for you to claim this depreciation, and even otherwise it is mandatory to claim the depreciation. However, new rates will be prescribed for claiming this depreciation for those companies which are opting for this optional scheme under BAB. And it further says that additional depreciation is not allowed to be claimed. It is only a basic amount of the depreciation which can be claimed for this purpose. So what are those deductions which are required to be ignored while computing the income? I have given this list in my slide. I am not referring to each one of them for the want of time. You can just refer, but just to highlight, out of the entire list, only the additional depreciation is the one which is having a timing difference, whereas all other deductions are permanent difference. So once you opt for this particular scheme, you're going to lose this benefit forever. But as far as additional depreciation is concerned, though you are not claiming it, to that extent your WDV of block will remain higher and you will be getting the benefit in the future years at least. So only additional depreciation is a timing difference. Chapter 6A, it is only Part C, that is it. Profit linked deductions are not allowed to be claimed. However, the deductions under other provision of Chapter 6A, like for example ATG, the company is allowed to claim it. Now this is an optional scheme of taxation. So the option is available with the company whether company wants to avail this option or not. And if the company decides that company wants to avail this option, in that case this option is required to be exercised in a prescribed manner. So rule will be notified for this purpose, a form will be notified for this purpose. And this option is required to be exercised within the due date under section 139(1) for furnishing the return of income of this particular consent company. And once you have exercised this option, you cannot withdraw this option at a later stage at any point of time. So you cannot just pick and choose that for some of the years I want to avail this benefit, and the later years I'll be enjoying some other deductions or the benefits which are not available under this provision. That is something which is not permitted. And the option is required to be exercised only once. So once you have exercised this option, this particular scheme will keep on applying to you forever for all the other years to come. Now here the issue is arising is that when this option is required to be exercised, whether this option is required to be exercised in the first year of incorporation of a new company, or whether this option is required to be exercised in the first year in which the company commenced the manufacturing activity, is because if you read this particular provision, I have just captured the wordings of this provision. It says that the option is required to be exercised on or before the due date for furnishing the first of the returns of income for any previous year relevant to AY 2021 or later assessment year. So the words used there are first of the returns. So the first of the return, does it mean that my first return after formation of the company, or my first return after I commence my manufacturing activity? And here I was unable to find a answer with respect to this issue, and this is the point where perhaps we need to represent to the CBDT or government that they need to come out with some more clarity as far as this issue is concerned. Is because if you take a position that this option is required to be exercised in the first year of incorporation, in that case, how do you avail the benefits if you have not yet commenced the manufacturing activity? Because availing the benefits under this provision is subject to the conditions, and one of the conditions is that the company has commenced, and the word used there is has commenced manufacturing activity on or before 31st of March 23. So for instance, I have just incorporated a company today. So my first assessment year will be 2021. But the year in which I am commencing my manufacturing activities, for instance, 2023. And if you take a position that this option is required to be exercised in the first return of AY 2021, but I have not yet satisfied the condition of commencing my manufacturing activity on or before 31st of March 2023, how the department will be applying the benefit of a concessional rate of tax on my income? Perhaps department will take a position that you have not yet satisfied the condition, and since you have not yet satisfied the condition, you are not eligible for this particular provision. And when I take a position that I will exercise this option in that year in which I commence my manufacturing activity and thereby have satisfied all the condition, perhaps the issue will arise that you had not exercised this option in your first return, and if you had not exercised your option in the first return now, how can you now turn up and exercise the option in a later assessment year and avail this particular benefit? So we don't have any clarity as far as this issue is concerned. Then we have some restrictions on the related party transactions. And what are the related party transactions for this purpose? It says that related party transaction is, the meaning of this is very broad. It says that related party transaction is business between this eligible company and any other person. Whether it's related concern or not is immaterial. The business between this company and any other person can be considered as a related party transaction if this business is producing an extraordinary profits due to a close connection or for any other reason. So for any reason, if any transaction between this company and other person is able to produce extraordinary profit, this can be considered as a related party transaction. And if this is considered as related party transaction, what will be the consequences of this? The consequences of this, that assessing officer will determine the ordinary profit and that excessive profit, unreasonable profit earned due to that close connection or any other reason will be ignored for this purpose. And further, it has been incorporated into the scope of the specified domestic transaction transfer pricing provision under section 92BA, and therefore if you cross the threshold of 20 crore which is there laid down in 92BA, you will also be subject to, in addition to this, you will also be subject to the transfer pricing provision, documentation, auditing, everything will apply. Now here I observed that there are two provisions being made applicable, and both of these are becoming incompatible with each other. It's because by applying transfer pricing provision, the concept under transfer pricing provision, it says that if by applying this transfer pricing provision, if it results into reduction of the income which otherwise computed on the basis of the books of account, then TP provision will never apply. Whereas here in 115BAB, it provides that by applying TP provision, we want to ignore the excessive profit and we want to reduce this income. So both of these provisions are conflicting with each other. TP provision says that reduction in income is not possible, and 115 BAB says that by applying this, we want to reduce the taxable income by ignoring that excessive unreasonable profit which has been earned out of this related party transaction. So how one would reconcile both of this conflicting provision is not very clear. Then further, this particular slide I can just explain with the help of this case study. So what is going to happen is that I have taken an example of two different transactions. So I have an eligible company on the first side, and there is a transaction with a related party, and this transaction is of sale of goods. So my eligible company is selling goods at 12 crores, whereas the fair market value or ALP if TP provision is applicable is just 10 crores. So my eligible company is trying to earn higher income by 2 crores. So this provision of BAB says that if because of this you are earning extraordinary profit, then profits and gains will be computed by taking only ordinary profits and excessive profit will be ignored. Fine. I don't have any problem with this. The issue is that this excessive profit of 2 crore which has been credited in my books of accounts, mean profit and loss account of eligible company, where are you going to shift this 2 crores? It says that the extraordinary profit will be ignored and only ordinary profits will be computed. So that means this 2 crore will not be taxable at all in the hands of the eligible company. There is no backup provision to say that this excessive profit will now be taxed at a normal rate of tax and not at a concessional rate of tax which has been given in BAB. There is no such backup provision. It has been merely provided in BAB that this excessive profit will be ignored for the purpose of computation of profits and gains for this section. That's all. It doesn't provide further anything. And therefore, what is happening is that idea is to not to give this benefit of a concessional rate of 15% to this excessive profit booked. But the way in which these provisions have been worded, it is resulting into a situation that this 2 crore will not be taxed at all in the hands of this eligible company, even not at a rate of 15%. Maybe possible that you may take a position that this 2 crore will now be shifted in the taxable income of the related party, possible, because in the books of the related party it is resulting into a purchase, and therefore you can either apply 48(2) provision by saying that you are booking excessive expenses in your books with related party and therefore that excessive portion is required to be ignored and taxable income can be increased, or by applying the transfer pricing provision is fine. But you look at the other situation, and the other situation is just a reverse of this. My eligible company is purchasing goods and the other person, related concern, is selling goods to my eligible company, and this transaction has happened in 8 crore, whereas the FMV or ALP of this is 10 crore. The same result, the eligible company is trying to book an excessive profit of 2 crores. Now this, in the second example, this excessive profit of 2 crores, nobody will be able to shift in the taxable income of the related parties, because in the books of my related party it is a sale, it is not a purchase. And therefore 48(2) will not apply on sales side, 48(2) will apply only on my expenses side. And therefore, assuming that the other related party is not falling into domestic transfer pricing provision because of threshold or because of any other reason, there is no mechanism whereby you can shift this 2 crore in the books of the related party or taxable income of the related party. And therefore, in that second example, perhaps this excessive profit of 2 crore, neither it can be taxed in the hands of eligible company even at 15% or normal rate of tax, even it cannot be shifted in the hands of related party, and therefore the anti-abuse provision is resulting into some benefits to the taxpayers. So concessional rate of tax, the question arises that this concessional rate of tax, whether it will apply to all types of income or only to business income. Provision says that this concessional rate of tax of 15% is applicable to the total income and not only to the profits and gains which is arising from a manufacturing business. And therefore the issue is that if you have other income, like there is a surplus fund which is being deposited into bank fixed deposit, you are earning interest income or some capital gains, etc. In that case, even this other income will also be taxed at 15%. Answer is yes, because there is no exception to this concessional rate of tax which is being provided in 115 BAB. But the issue is that what if that amount of other income is substantial? Please note that this other activity generating other income should not be resulting into a non-manufacturing business. Is because if that activity results into a non-manufacturing business, you will lose this particular benefit altogether, even to your manufacturing business profits. What if the anti-abuse provision is also triggering some income? So, for example, the domestic company eligible for this purpose opted under this provision has issued shares at a premium, and there is a income which is getting triggered under 5627B. Whether such an income under anti-abuse provision is also taxable at a concessional rate of tax of 15% or not? Answer as on today, as it stands, is yes, is because you don't have any exclusions from applicability of concessional rate of 15%. Going one step further, what if this particular company which has exercised this option is getting assessed? So any enhancement on the income at the assessment stage is also taxable at 15%. There is no mechanism that if there is an enhancement in the income at the assessment stage, unless some specific provision is applicable, for example, there is an undisclosed income which can be taxed at 16% is a different matter. But leaving aside those specific situation, if there is an enhancement of the income in general, even to this 15% rate of tax is applicable. Going one more step further, what about penal provisions? Even the penalty with respect to underreporting or a misreporting of income under section 270A will also be computed with reference to this concessional rate of taxes, because the mechanism under 270A, the penalty 50% or 200% is on the basis of the amount of tax payable, and the amount of tax payable is required to be computed as per the provisions which are applicable to that company, and therefore the assessment, enhancement in the assessment and the consequential penalty under 270A is also required to be computed at a concessional rate of tax. What if there are violation of the conditions in the subsequent year? There are some of the conditions which are required to be satisfied even in the subsequent year, like you should not be engaged into a non-manufacturing business, second-hand plant and machinery, etc. So what will be the violation? If it is found that the conditions are not being satisfied in the subsequent year, whether the benefits of 115 BAB, can it be withdrawn retrospectively? So somewhere in 25-26, the assessing officer found that I have now started doing some other business. Can assessing officer can reopen the assessment for all the years and can say that now I'll not apply the provisions of 115 BAB to you? There's no clarity on this, but it appears that the way in which these conditions have been worded, and even logically, as long as for all other past year, as long as I have satisfied the conditions, looking at the objective of the provisions, for those year I should be granted the benefits, but moment I have violated the condition, prospectively this benefit can be withdrawn. If these benefits have been withdrawn, whether I will be given an option to now switch over to 115 BAA, which is 22% tax, and there are no such stringent condition. But the difficulty is that 115 BAA also mentions that option is required to be exercised before the due date of filing of return, and now I have already reached to the assessment stage, and therefore can I say that I had never visualized that situation that 115 BAB I will become ineligible, and I should have even opted for 115 BAA at that point of time, and therefore on the ground of impossible task which was required to be performed, one can argue that yes, that switching over of option should be made available, and there are court decisions which says that filing of such audit report or exercising such option is something which is directory. It should not be interpreted as mandatory. If the violation is found, will it result into any penal consequences? The answer is no. So if the manufacturing company has filed the return claiming tax at 15% and it was found that this company is not eligible, and this company is now taxed at a normal rate of tax, will it result into penal consequences? Answer is no, is because the penal consequences under section 270A goes with respect to under-reporting of an income and not the short payment of the tax. The whole computation mechanism of penalty under 270A doesn't capture if that same income, the amount of income remaining the same, only the tax rate is getting deferred. There is no mechanism to capture this particular situation under penal provision of section 270A. And that's where I'm coming to an end of my presentation, that is section 115 BAA. I'll just take a couple of minutes and I'll run through the slides. Here it's a second option which is available to the domestic companies once again, where the effective tax rate would be 25.168%. Who is eligible to opt for this option under BAA is any domestic company, irrespective of any other condition. It need not be a manufacturing business. It can be an old company. It need not be a new company for this purpose. The size of the company doesn't matter. Even it is not mandatory that the company should be engaged into a business. Even if there is a company which is earning just passive income, even that company is also entitled to opt for 115 BAA. So a trading company engaged into providing services, all such companies are eligible to opt for this provision. This is also an optional scheme. It is not something which is mandatory. The provisions are on a similar line as I discussed with you on 115 BAB. There is a CBDT circular which says that, clarifying two things. This is mainly for 115 BAA, which says that if you have unutilized MAT credit which is being carried forward and now you are opting under 115 BAA, in that case this MAT credit will not be available to you, is because MAT provision altogether doesn't apply to you once you opt under this BAA. That's the view which has been given, that is the view which is being adopted by CBDT. However, it is not free from doubt. Further, it says that if you have brought forward losses on account of additional depreciation, that loss also will not be allowed as a set-off once you opt for BAA. However, the question arises that whether this unabsorbed depreciation, can it be considered as a loss? Because there are Supreme Court decision which says that the depreciation cannot be considered as an expenditure or a loss. So this is a snapshot comparison which I have given in tabular form just to end the presentation. So this is how one can make a choice depending upon availing the specified benefits with respect to those depreciation or tax holiday benefits or the concessional rate of tax. So somewhere some of the benefits are available, some of the benefits which were available otherwise are required to be forgone, is required to be ignored for this purpose, and one will have to make a proper balanced choice depending upon several other facts and circumstances. It will not be possible for me to discuss this particular factors which are required to be considered while making a choice in more details for the want of time, but you can take the help of this particular summary while making such a decision. And the other two amendments are very simple with respect to MAT and buyback tax, which I have just discussed, and therefore I'll just end my presentation. If there are questions, the time permitting, I'll be happy to deal with these questions from the floor. And I thank BCS for giving this opportunity to me to discuss and analyze this particular tax amendment ordinance. Thank you, friends.
Thank you, Bhadresh, for your flawless presentation.
Yes. The loss not attributable to those deductions can be claimed. Yes. Once you exercise that option, MAT is inapplicable.
So company which is engaged in production activities but not manufacturing activities, they can claim benefit of 115 BAB, right?
Yes, right. It's manufacture or production, either or.
Sir, and whether contract manufacturing and toll manufacturing will be considered?
So that's what I had covered in my slide. No, so if you are doing manufacturing for someone else, right, as long as you are manufacturing this, you are eligible for 115 BAB.
And the person who outsources it is not
completely outsourced?
Completely.
No. Only some of the activities
Yes.
outsource, and you are doing otherwise predominantly all other activities of manufacturing, you are entitled.
Like a company which has built the design of the product, the designing is done by the company, but only manufacturing the product is outsourced.
So that's where the difficulty is going to arise. So merely preparing only design, whether can it be said that you are engaged into a manufacturing activity?
Okay.
It will be difficult to say so. So all the decisions with respect to this, it says that if some of the activities have been outsourced, otherwise you are otherwise also carrying on many other activities, which is part of a manufacturing process, you should be given this particular benefit. Ashok sir.
Can we have other?
Sorry? Yeah, so sorry, I had skipped those two exceptions. Up to 20% in value, you are allowed to use this second-hand plant and machinery. Yeah. So there is no clarity on this, whether it's a book value, original cost, WDV, fair value, there is no clarity on this.
After exercising this option, if a company merges with another company, what would be the tax consequences, which is not exercise this option? Say if
So
a company,
then that merged company would fall under the normal provisions.
okay,
Because this company which had exercised this option is going out of existence.
and supposing if it's vice versa, then
Vice versa, then we need to see that whether you are still satisfying those conditions which are there under BAB.
okay. But what about the carried forward loss of this in the vice versa case, what about the carried forward
So
losses
carried
of?
forward losses, as per the other provisions, you are entitled to claim in unless it is attributable to those specified deductions.
But there is no,
Sorry?
but there is no provision for rollover or any kind of exemption for merging companies.
No specific provisions for this. It merely says that it should not be splitting up or reconstruction.
Credit available under that 115 JV, whether still we can, if we opt for the new provisions,
115 BAA.
whether carry forward is still allowed to be set up.
So it's a highly controversial issue. CBDT has taken a position that this MAT credit will not be allowed to you once you opt for. And CBDT further says that if you have a MAT credit, you please exhaust that MAT credit first. Why are you in hurry to exercise this option of BAA? And once you have exhausted this MAT credit in a later year, then you exercise this option of 115 BAA. So CBDT is very clear in its view, which is there in the circular. The other view is that since the provisions of 115 JAA under which a MAT credit has been granted, there is no amendment to this. Further, on the ground of promissory estoppel, that you had been given that particular promise that you will be given the set-off of MAT credit. Yes. Why don't you give that MAT credit benefit even under this new regime of optional regime of 115 BAA?
Bhadresh, you covered in your presentation a detailed, on the definition and the case laws that we have on manufacturing. So I was under thinking that whether chartered accountants are also expected to be engineers or no. We in the audit practice usually have follow the practice of providing or provision for taxation the audit team does, and then for critical cases it goes to the tax department to have a look at it. But I think so even for with so many permutation and combinations possible, it will be difficult for us, for the audit team also, to just make a provision. Even though it's a provision, it's not an exact liability, but even providing for tax laws. I think so with these words, I thank Bhadresh a lot for staying for us beyond time. And before we conclude, I'll just request Mihir Bhai to propose a formal vote of thanks.
Well, before I do the privileged task of giving a vote of thanks to the speaker, let me announce some forthcoming events, and they are very interesting. There is a Human Resource Development Committee's event called Achieving Success, Living Values, which is on Sunday, 24th November. Ideally, it is for younger chartered accountants and their associates. So if you have your colleagues, please ask them to go on to the site, and this is at the RVG hostel. There is a very interesting session, and I repeat, it is the event on 27th of this month, November. R. Gopal Krishnan, who's a vice chairman of Tata Trust and also ex-vice chairman of Hindustan Lever, he's giving a lecture on corporate Ayurveda, and I think everybody needs this in current times. So please make it a point to attend. It is at the same venue here on 27th November in the evening. There's a full-day seminar on estate planning, wills and family settlements, critical aspects on Friday, 13 December at Walchan Hirachan Hall on the 4th floor of IMC. And that's a seminar. It's a paid seminar, but I think this is a topic and subject of the time. There is a workshop on NBFC on Friday, 13th December at the Orchids Hotel, Ville Parle, and that's a paid workshop. There is a DTTA, that is a 20th DTTA conference and a course at the BCS conference hall. And there is the RRC in January between 9th and 14th. If you are 12th, if you're not enrolled, I would request you not to miss out this. This is the event that BCS has been holding for a number of years. So please make it a point to attend. And now let me turn to the honorable task of giving a vote of thanks to the chair. Sure. This is the tradition that we have in the BCS, an instant photograph. while we profoundly thank the speaker today for his incisive analysis, I'm afraid that when we ask ourselves this sincere gratitude is for what reason, then there is a contradiction or an oxymoron that we come up with. That we are actually thanking him for shattering our life that we were living with bliss. How happy we were thinking that India is progressing, things are getting changed, and suddenly here is a man who comes with his precise analysis, not only of what the things that they are, but what they could be, because this is exactly what is going to happen, how they are going to be interpreted. And as you said, there are 12 rates. I don't know how the utilities are going to cope up with that. And we will still be at the same stage, struggling till the last date and wondering when the computer will work, when the utilities will come, and then going and requesting the bureaucrats and the finance minister for extension. But I don't think so. Any analysis could have been more incisive, more precise, and this is what the depth of the speaker is. He's a very great, dear friend of BCS, and I'm quite sure BCS is also very close to his soul. So thank you, Bhadresh Bhai, and we will look forward to having you.